Hello and welcome to this week's market update from CBN Financial. I'm your AI host, covering the key developments in the U.S. equity market for you, so you have the context and insight needed to make informed investment choices as October winds down. This week, the major U.S. stock indexes continued their strong run, with the S&P 500, Dow Jones Industrial Average and Nasdaq Composite showing healthy gains and closing at or near all-time highs. A major catalyst was the remarkable performance of Amazon.com, Inc., which surged around 11% after reporting strong earnings and an accelerating cloud revenue business. This helped lift investor sentiment broadly. In the technology and AI-related sector, the rally remained strong though not without caution. NVIDIA Corporation saw gains as it flagged optimism for its next-gen Blackwell chips and potential China sales. But investors are still uneasy about how much heavy AI spending by several large companies can sustain margins and growth long-term. On the macro front, inflation and interest rate expectations remain pivotal. With less fresh economic data, some of which has been delayed due to the ongoing U.S. government shutdown, markets are closely watching for signals from the Federal Reserve. The expectation of future rate cuts is helping support equities, but the lack of visible data adds uncertainty. Meanwhile, trade and global growth concerns linger, especially in relation to China. Putting it together, the market is in a strong phase but carries fragility. A handful of mega-cap tech firms are doing much of the heavy lifting, which raises questions about breadth of participation. For example, despite index highs, underlying market breadth was poor on recent strong days. What this means for your investment choices. 1. Favor quality and leadership. Given the dominance of large tech/AI names, consider exposure to companies that are actually delivering strong growth or have sustainable competitive advantages. The likes of Amazon and NVIDIA may continue to lead, but also weigh valuation risk. 2. Be cautious about overconcentration. With market gains driven by a narrow set of companies, diversification remains important. Don't overly rely on just the headline winners. Evaluate whether sectors or smaller firms offer value. 3. Watch for risk triggers. Key risks include slower than expected earnings in tech/AI, an unexpected rise in inflation or interest rates, delays or surprises in economic reporting, and renewed trade tensions, particularly China. Any of these could cause a reset. 4. Use valuations and fundamentals. While momentum is strong, make sure you're looking at earnings, margin prospects, competitive dynamics, not just share price appreciation. The AI spending boom is real, but questions remain about how much of that translates into profit. 5. Consider the broader market context. With expectations of rate cuts and low yields still supporting equities, the Hello